Today we're diving deep into the world of cybersecurity and how you can invest in this booming industry. But before you jump in and buy all the hot cyber stocks, there might be a better way. We're talking about the CIBR ETF, a one-stop shop for cybersecurity exposure. But is it all sunshine and rainbows? We'll crack open the expense ratios, track down those hidden fees, and see if the CIBR ETF is the perfect weapon for your investment arsenal. Can you beat the ETF by picking individual stocks? Is there a costlier cyber villain lurking in the shadows? We'll answer all this and more, so buckle up and get ready to chat about the CIBR ETF. Question 1. What is CIBR ETF? The CIBR ETF, or the First Trust Nasdaq Cybersecurity ETF, is an exchange-traded fund designed to provide investors with exposure to companies involved in the cybersecurity industry. Let's break down its key features. Investment objective. The primary objective of CIBR is to track the performance of the Nasdaq CTA Cybersecurity Index. This index focuses on companies classified as cybersecurity firms by the Consumer Technology Association, CTA, and have a minimum market capitalization of $250 million. By investing in CIBR, you aim to achieve capital appreciation by mirroring the growth of the cybersecurity sector. The ETF doesn't prioritize generating significant income through dividends, although some holdings might distribute dividends. Strategy. CIBR utilizes a passive management approach. It seeks to replicate the holdings and weighting of the underlying index as closely as possible. This means the fund doesn't involve active selection of securities by portfolio managers. There are two primary methods for replicating an index: full replication and sampling. It's likely CIBR employs a sampling strategy, where it invests in a representative selection of the index constituents instead of holding all of them. This helps to reduce costs associated with buying and managing a large number of securities. Benefits. Diversification. CIBR offers exposure to a basket of cybersecurity companies, mitigating the risk associated with relying on the performance of a single company. Convenience. The ETF provides a one-stop solution for investing in the cybersecurity sector, eliminating the need for individual stock selection. Liquidity. CIBR trades on a major stock exchange, Nasdaq, like any stock, offering investors easy entry and exit points. Potentially lower costs. Compared to actively managed funds, ETFs typically have lower expense ratios, which can translate to higher returns for investors over the long term. Considerations. Market volatility. The cybersecurity sector can be susceptible to market fluctuations. CIBR's price is likely to experience swings based on industry news, cyber threats, and overall market conditions. Tracking error. Even with a sampling strategy, CIBR's performance might not perfectly match the underlying index due to factors like bid-ask spreads and rebalancing costs. Limited control. As a passively managed fund, CIBR doesn't offer the potential for outsized returns that active management with skilled stock picking might achieve. Question 2. What is the primary objective of the CIBR ETF? The primary objective of the CIBR ETF is to track the performance of the cybersecurity sector, aiming for capital appreciation for investors. Here's a breakdown. Investment goal. Capital appreciation. CIBR prioritizes growth in its net asset value, NAV, which reflects the overall value of the ETF's holdings. As the share prices of the underlying cybersecurity companies increase, the NAV and the price of the CIBR ETF are expected to rise as well. This translates to capital appreciation for investors who hold the ETF over time. Strategy and tracking. Passive management. CIBR follows a passive investment strategy. It tracks a specific index, the Nasdaq CTA Cybersecurity Index, which represents a basket of companies in the cybersecurity sector. The ETF doesn't involve active selection of individual stocks by portfolio managers. Mirroring performance. The goal is for CIBR's performance to closely resemble the performance of the underlying index. By holding a representative sample of the index constituents and mimicking their weighting, the ETF aims to deliver returns that reflect the overall growth of the cybersecurity sector. Limited income focus. While some of the companies within CIBR might distribute dividends, generating income is not the primary objective. The focus is on capturing the capital appreciation potential of the cybersecurity industry. Investor takeaway. If you're looking to invest in the cybersecurity sector and benefit from its potential growth, CIBR offers an avenue to achieve that. By tracking a relevant index, the ETF provides exposure to a diversified basket of companies within the cybersecurity space, aiming for overall capital appreciation for investors. Benefits. Diversification. CIBR offers exposure to a basket of cybersecurity companies, mitigating the risk associated with relying on the performance of a single company. Convenience. The ETF provides a one-stop solution for investing in the cybersecurity sector, eliminating the need for individual stock selection. Liquidity. CIBR trades on a major stock exchange, NASDAQ, like any stock, offering investors easy entry and exit points. Potentially lower costs. Compared to actively managed funds, ETFs typically have lower expense ratios, which can translate to higher returns for investors over the long term. Considerations. Market volatility. The cybersecurity sector can be susceptible to market fluctuations. CIBR's price is likely to experience swings based on industry news, cyber threats, and overall market conditions. Tracking error. Even with a sampling strategy, CIBR's performance might not perfectly match the underlying index due to factors like bid-ask spreads and rebalancing costs. Limited control. As a passively managed fund, CIBR doesn't offer the potential for outsized returns that active management with skilled stock picking might achieve. Question 3. Which index does the CIBR ETF track? What is the methodology used by the index provider for selection and weighting of constituents? The CIBR ETF tracks the performance of the Nasdaq CTA Cybersecurity Index. This index, created by Nasdaq in collaboration with Cyber Technologies Alliance, CTA, specifically targets companies within the cybersecurity industry. Here's a closer look at the methodology behind its construction. Selection criteria. Industry classification. Companies must be classified as cybersecurity firms by the Consumer Technology Association, CTA. The CTA likely uses a set of criteria to define a cybersecurity company, potentially including factors like the nature of their products and services, target market, and revenue streams heavily reliant on cybersecurity solutions. Market capitalization threshold. A minimum market capitalization of $250 million is required for a company to be included in the index. This ensures a focus on established companies with a certain level of financial stability. Weighting methodology. Free float market capitalization. The weighting of each company within the index is based on its free float market capitalization. Free float refers to the portion of a company's shares readily available for public trading. This weighting methodology ensures companies with a larger market capitalization and wider public ownership have a greater influence on the index performance. Capping mechanism. To prevent any single company from dominating the index and influencing its performance too heavily, the index employs capping. There's likely a limit on the maximum weight any individual security can have within the index. Additional considerations. Liquidity requirements. The index might have minimum liquidity requirements for its constituents. This ensures the underlying holdings can be easily bought and sold by the ETF to maintain its tracking objective. Periodic rebalancing. The index undergoes rebalancing semi-annually, typically in March and September. During rebalancing, the holdings and weightings are adjusted to reflect any changes in the market capitalization or eligibility of the constituent companies. Additionally, if a company within the index no longer meets the criteria throughout the year, it might be removed before the next scheduled rebalancing. Benefits of the methodology. Industry focus. By relying on the CTA classification and a minimum market capitalization threshold, the index targets established companies within the cybersecurity sector. Diversification. Free float market capitalization weighting helps achieve diversification within the index, reducing reliance on any single company's performance. Reduced dominance. Capping individual security weights prevents any single company from swaying the index performance excessively. Regular rebalancing. Semi-annual rebalancing ensures the index reflects the evolving market landscape within the cybersecurity sector. Question 4. How does the CIBR ETF replicate the underlying index? Does it use full replication, statistical sampling, or optimization? CIBR most likely utilizes a statistical sampling approach to replicate the performance of the Nasdaq CTA Cybersecurity Index. Here's a breakdown of the replication methods and why sampling is the likely choice for CIBR. Replication methods. 1. Full replication. This method involves holding all the securities in the underlying index in the exact proportions as their weighting. While it ensures perfect tracking, full replication can be impractical for several reasons. Transaction costs. Buying and selling a large number of securities can incur significant transaction costs, which can eat into the ETF's returns. Liquidity challenges. Some index constituents, particularly smaller companies, might have limited liquidity, making it difficult for the ETF to acquire and dispose of their shares efficiently. Cash drag. Holding a large number of securities might result in some cash being held uninvested, reducing the ETF's potential return. 2. Statistical sampling. This method involves selecting a representative subset of the underlying index constituents. The selected securities are then weighted in a way that attempts to mimic the risk-return characteristics of the entire index. Sampling offers several advantages. Cost efficiency. By holding a smaller number of securities, transaction costs are reduced, benefiting investors. Improved liquidity. The ETF can focus on more liquid holdings, making it easier to buy and sell them to track the index. Reduced cash drag. With fewer holdings, there's less uninvested cash, potentially leading to higher returns. 3. Optimization. This method involves using mathematical models to select a portfolio of securities that achieves a specific objective, such as minimizing tracking error, the difference between the ETF's performance and the index's performance. While potentially offering the closest tracking, optimization can be complex and might introduce unintended risks. Why sampling is likely for CIBR? Considering the potential for a large number of constituents in the Nasdaq CTA Cybersecurity Index, full replication could be expensive and impractical. Statistical sampling offers a good balance between cost efficiency, tracking accuracy, and liquidity management. Optimization, while potentially offering the closest tracking, might be unnecessary for CIBR's objective and could introduce additional complexities. Question 5. What is the expense ratio of the CIBR ETF? How does it compare to other similar ETFs and actively managed funds? The expense ratio of the CIBR ETF is 0.59% as of February 1, 2024, according to sources like First Trust Portfolios and ETF Database. This expense ratio represents the annual fee deducted from the ETF's assets to cover operational costs like management fees, administrative expenses, and marketing. Here's a breakdown of how this compares to other investment options. Comparison with similar ETFs. Look for ETFs that track similar cybersecurity indices or invest in the same sector. Research their expense ratios using financial websites or ETF provider databases. Here are some examples. Lower expense ratio ETFs. If you find similar ETFs with expense ratios significantly lower than 0.59%, it might be worth considering them for potentially higher returns after fees. However, consider factors like tracking error, liquidity, and specific index holdings before switching. Higher expense ratio ETFs. Some competing ETFs might have slightly higher expense ratios, around 0.65% minus 0.75%. This could be due to a more complex replication strategy or additional services offered by the ETF provider. Evaluate the trade-off between fees and potential benefits before making a decision. Comparison with actively managed funds. Actively managed funds in the cybersecurity sector typically have higher expense ratios than ETFs. These can range from 1% to 2% or more. The higher fees reflect the ongoing research, analysis, and portfolio management activities undertaken by fund managers. Consider your investment goals and risk tolerance. If you prioritize a lower cost, passive approach to investing in the cybersecurity sector, CIBR's expense ratio might be a good fit. However, if you're willing to pay a higher fee for potentially superior returns through active management, exploring actively managed funds could be an option. Question 6. How liquid is the CIBR ETF? The liquidity of the CIBR ETF can be assessed through several factors. Trading volume. Check the average daily trading volume, ADTV, of CIBR. A higher ADTV indicates a more liquid ETF, where buying and selling can be done efficiently with minimal impact on price. You can find this information on financial websites or ETF provider databases. Look for historical data on ADTV to understand potential fluctuations. While the ADTV might be high on average, there could be periods with lower volume, impacting your ability to enter or exit positions quickly. Bid-ask spread. The bid-ask spread represents the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask, for a share of the ETF. A narrower bid-ask spread indicates better liquidity, as investors can buy and sell closer to the ETF's true market value. Research the historical bid-ask spread for CIBR. While a tight spread is desirable, some widening might occur during periods of market volatility or lower trading volume. Underlying holdings. The liquidity of the CIBR ETF is also influenced by the liquidity of its underlying holdings. Since the ETF likely uses statistical sampling, the specific holdings might not be publicly available. However, the index methodology often focuses on companies with a minimum market capitalization. This suggests the ETF holds established companies with a higher likelihood of being liquid in the stock market. Index rebalancing. The index rebalancing process, typically semi-annual for CIBR, can temporarily impact liquidity. During rebalancing, the ETF might need to buy or sell holdings to adjust weightings. This activity could lead to wider bid-ask spreads or temporary fluctuations in the ETF's price.